There was a quote in this movie called The Horse Whisperer, and I'll play the clip here for you. He didn't have people with horse problems, he had horses with people problems.
I read this article about what you do for people with horse problems.
Well, truth is, I help horses with people problems.
Yeah. So we don't have people with portfolio problems, we have portfolios with people problems from time to time. Some financial professionals are no different, but every once in a while when, we're having some negative periods, there's nothing wrong with the portfolios. There's nothing wrong with them. This was December 26th, before the market opened. And if you remember, December 24th was the bottom of the market. And of course, nobody knew at that time that we'd have this rally that we've had. I had no idea, nobody had any idea. And so this guy, he comes on before the market opened, and I'll show you the clip on him, but the gist of it, investors were pulling out the most of their stock funds since 2008. They were bailing out of the market like crazy during the last couple of weeks of December 24th. And then, so you see this happening, and then you see this guy on TV, Peter Borish, he comes on and says this.
Are you buying safe havens? Is that the right way to go?
Well, there's so much going on here. You need to wait until the falling knife bottoms. So you first wait for it to bounce a little bit. So today maybe we'll have a bounce, maybe to the end of the year. But no, it's not the time to be putting risks back on. You have the three legs of the stool: fiscal policy, monetary policy, and public policy, all wobbly. Until you see some stability there, I would be cautious.
So you have to wait for the three legs of the stool before you can invest again. And so this is before the market opened that day, December 26th, and this is what happened that day, December 26th. Okay. Market's up almost 5% in one day. Now he's sitting in an interview somewhere, and now he's having to decide, wow, was that the bottom of the market? Or maybe it's going to come back down again, but the three legs of the stool are still there that I just talked about. And then this is sad. This is really, really sad. This is February 4th, 2019. Mom and pop sit-out rally with stock exposure at 6-year low. January may have seen the strongest start to the year for the U.S. stocks in more than 3 decades, but many retail investors watched from the sidelines. Clients of TD Ameritrade, already skittish at the end of 2018, further cut their exposure to stock market in the first 4 weeks of the new year. So they cut their exposure in December, and they continued to cut it in January. The firm's Investor Movement Index, which tracked clients' positioning since 2010, declined for the 4th straight month, its lowest since July 2012. That, as the S&P 500 index gained almost 8% in January, the best month for equity benchmark since 2015. The index hasn't seen a big January rally since 1987 when it soared 13%. And February was a good month too. Our clients did not miss the rally. They didn't. Did anybody miss the rally? No. It's sad, really sad. Stock market rally start 2019, one for the history books. Dow has best 2-month start since 1987. Now, I don't know what the next 2 months are going to be. All I know is we need to stay prudently invested for the reasons we stated in our last class. Investor behavior is still the biggest cost for many investors and the major reason for poor portfolio performance. There's a lot of companies that do these studies about investor cash flows, just like the one I just showed you. This is Dalbar. This is the last 20 years through 2017. They haven't put out the 2018 numbers yet, but they're always very similar. Over the last 20 years, the S&P 500 averaged 7.2%. The average equity stock investor averaged 5.29%, a difference of 2% per year, precisely because of what I just showed you. They sat out those rallies, and then they get back in. They only hold their portfolios for 3.45 years. Scott and I call that the 3-year itch. We got to do something. The data suggests that investments consistently outperform the investors. Think about that for a second. The investments that they invest in outperform the investors because of their cash flows. It's called the behavior gap. This is the investment return, and this is what they get because they get in and out at the wrong times instead of rebalancing. That's why we spend so much time and effort on education. We want to shrink or eliminate that performance gap for you guys.